Gang, thank you for coming. We're glad that you're here. And again, any questions that you have, just put them in the chat. One of the key things that we want to do today is make sure that we answer your questions. We're here for you. So I met Daniel and Matt Sorensen at the Secrets of Successful Syndication webinar, or seminar, I should say. This is the webinar. And because of that, we started talking about possibly doing a webinar together. So it was really great to get to meet them, got a chance to get Matt's book and have him sign that for us, and just was very impressed with what they offer and with what that means for investors. There are so many nuances to the self-directed IRA that can be game changers for investors. And so I felt it would be really awesome if we could deliver some of this content to our investors and provide a resource that would help get you educated on what's happening with self-directed IRAs. All right, it looks like Daniel, I'm going to go ahead and let you get started. I got a little tech to work on in the background
Yes.
back here. We see the note about the chat being disabled, so we'll get rolling with that. All right, let's go.
Let me share my screen. All right, that, and we'll do this. Okay, so thanks everybody. Thank you, Scott, for letting me come on. He's going to be fixing the chat. Thank you guys for noticing that. Please feel free, as I'm speaking, write your questions into the chat. I will address them as they come up, or maybe I'll say we'll be getting to that in a second and I'll get to it a little later. But just so you guys are all aware, my name is Daniel Tercey. I can see it, Scott. I am a senior account executive over here at Directed IRA. We are one of the fastest growing self-directed IRA companies in the country right now. And as Scott mentioned, we're founded by Matt Sorensen and Mark J. Kohler. Matt is the writer of the Self-Directed IRA book. Both Matt and Mark are CPA lawyers, and I've had the privilege of training under both of them. That's why I get to go out and do these presentations and help educate people such as yourselves. And I personally have helped hundreds of investors learn how to take control of their retirement plans. And I do this through public speaking and educations, just like what I'm doing right now. And really what I'm going to be going over is the ins and outs of alternative assets, or as Scott likes to put it, real assets, which I really like that term, real assets, and how you guys can actually purchase these real assets through your 401ks, IRAs, HSAs, ESAs, all sorts of qualified plans. And my main focus is primarily real estate investing and private money lending. But I run the gambit of how to use your IRA to invest in these other assets. And as we all know, we start out with the disclaimer, so I'll get the boring stuff out of the way. I'm not here to provide any tax, legal, or investment advice, okay? I'm here purely for education purposes, okay? And through this presentation, I'm going to be going over how you can control your retirement and invest in things like real estate, like syndications, like mineral oil rights. And I'm going to show you examples of deals from people who've done those types of investments. And I'm also going to show you that not all deals are created equal. Okay, so I know there's not a lot of us, so let's get some engagement. How many of you guys actually have retirement plans, whether it be IRAs or old 401ks? You can just put like a 1 in the chat. Let's see if our chat's also working too.
Yeah, I think we're up and running.
All right. Well, I don't see a lot of engagement. I'm assuming you all have some retirement plans. Oh, how many of you guys have retirement plans? Do you have old 401ks, IRAs, anything like HSAs, ESAs, anything like that? And hopefully you guys can hear me. Yeah, perfect. All right. Well, I'm here to tell you that all IRAs and all retirement plans are actually all the same, and they can all do the exact same. All right. They can all hold all of these assets right here that you see on your screen. Now, for those of you that have 401ks, you're probably used to doing stocks, bonds, and mutual funds. And you may even have IRAs that are probably invested in stocks, bonds, and mutual funds. Might be with a Fidelity or a Schwab. And the reason why most people think they can only do stocks, bonds, and mutual funds is because Fidelity and Schwab make money on stocks, bonds, and mutual funds. Therefore, they make sure that you invest in only those things. But all custodians under the IRS tax code can actually hold all of these investments. It just depends on what the custodian wants to do. We are an alternative investments custodian, so we just want to be the best custodian we can be for you and allow you to self-direct into all of these other assets. So you can see in here we have real estate, precious metals, that's been kind of gangbusters over the last couple of months. Cryptocurrencies, you can invest in private businesses. You can invest in energy and natural resources. This is another big one that I see, especially out here in the Texas area. And then we also have private money lending, so things like promissory notes. That's another great passive way to do some investing. Just so you're aware, there are two types of assets you cannot hold in your IRA: life insurance contracts and collectibles. So you can finally get rid of your Beanie Babies and Pokemon cards. There's no way you're going to get those tax exempt. And then your life insurance contracts, let's be real, if you have one of those in your IRA, you're just asking for a really short true crime documentary, right? They're going to find you really fast. So those are all of the assets you can hold, and the only two you cannot hold. Now, I mentioned earlier that these are all going to be, with us, self-directed IRAs. So just to go over what a self-directed IRA means, it's just a marketing term. It just means that you're going to go out, you're going to find the deal, whatever it may be, and then you're going to ask your custodian, hey, here's what I found, here's a direction of investment form, please send the investment money over to this deal, okay? And just to really reiterate how much of a marketing term this is, Fidelity and Schwab actually offer self-directed IRAs. If you call it Fidelity and Schwab right now and you say, hey, I listened to this kid tell me about self-directed and I want to start self-directing into alternative assets, they're going to ignore that you said alternative assets and say, sure, no problem. We'll get you into a self-directed IRA. You can self-direct right into stocks, bonds, and mutual funds, whatever you would like, right? We allow you to do all of it, but you have to go out and find the deals. So anybody that's an active investor right now, everything you're doing right now, that's the exact same way you're going to be doing inside of your IRA.
Good stuff.
So real estate investing, why is it so attractive? So first off, real estate's one of the largest segments of the economy. And I would make an argument that if you're not invested in real estate in some degree, whether it's syndications, private money lending, or just straight up buying and holding a home, you're really missing the boat on this. And number two is real estate gets certain avenues of revenue that you don't really get with stocks. Like, sure, stocks appreciate, so do homes, right? But like real estate also can cash flow, okay? And you can kind of equate that to dividends, but I don't know how many dividends are given $1,000 a month, $1,200 a month, right? And then third, and I'd say this is probably the most important, most millionaires are made from real estate. And you're always going to see these assets, right? People have to have a home. So 3 reasons why you should be investing in real assets or alternative assets inside of your IRA. First, they're tangible, right? When is the last time anybody's like held a stock in their hand? Or maybe the last time somebody's driven by a bond, right? It just doesn't happen, okay? And the other great thing about a tangible asset is, let's say it burns to the ground. What happens then? What, you're going to get insurance money? That sounds pretty good. What about the land that's underneath that home? That's worth something, right? Somebody's going to want to develop on top of that burnt down house, right? So you still have 2 avenues of getting money. What happens if a company goes belly up? It's worth 0, right? There's nothing left there.
You got it. Yeah. Actually, Daniel, I'll add to that. We had a house in one of our portfolios that burned down this past December, and we're in the process of rebuilding. Insurance is covering it, and so we're handling that first side of it. But the next door neighbor completely burned down, and they're left with a lot. So
Yep.
it works.
And in some cases, if you own it, heck, sometimes that house wasn't really that great anyway. Now you get to build a newer, better home. So
You got it.
it'll cost some money, but at least you know it's going to be newer and better. Hey, maybe there was some asbestos you didn't know about or some mold. Now it actually worked out for you. I'll stop with the dumb jokes. Anyway,
That's great.
second, and I think this is one of the most important parts. Obviously, tax savings is, but the diversification. So I really want to go over the diversification. So it may sound like I'm talking bad about Fidelity and Schwab, but the reason why I kind of go after Fidelity and Schwab is they've let us all believe that we could only stay in these things. And those things are stocks, bonds, mutual funds. And they tell us you need to be diversified. So what do they tell us to diversify into? Stocks, bonds, and mutual funds, right? That's not true diversification. True diversification is investing in stocks, bonds, and mutual funds. Have that IRA set up to stay invested in the stock market. All of my clients have some money in the stock market, but they also have some of their money in alternative assets. Another way you can diversify. The stock market didn't do so great the last 4 or 5 months, right? And there's been some things that have been going on that are leaving a lot of uncertainty in the stock market right now. So why shouldn't you be available to invest in alternative assets as well? And that right there is true diversification. Okay. And then lastly, I know I talked so much about all this other stuff and everybody just wants me to shut up and say, hey, Daniel, how do I do all this tax free, right? So within your 401k, everything you are doing is tax exempt. You buy a home, tax free. You collect rent, tax free. You sell the home, tax free, right? So everything that you are doing is going to be driving your money to grow stronger and faster, okay? I have a real estate investor that always tells me it's not about how much money you make, it's about how much money you keep. And inside of an IRA, you keep all of it. Okay. Now, for those of you that haven't been paying attention, this is the slide and in the next coming slides. These are ones you really need to pay attention to because these are all of the plans that if you qualify for, you can use to invest tax-free. Right? And I'm going to go over these in detail on the next slides, but just briefly going over it, these personal plans, these are ones that anybody can have, okay? You don't have to be self-employed. You don't have to have, a health insurance program that qualifies you for an HSA. You can right now set up a traditional IRA. Anybody can. Anybody can set up a Roth. I know some people might say, well, I make too much money. That's not true. You can do what's called a backdoor Roth. So anybody can set up these plans. Employer plans, I know there's not a lot of us in here, but is there anybody in here that's self-employed right now? This is going to dictate how much I go into on these, because I could do a whole hour-long conversation on solo 401ks. These things are great. But anybody self-employed in here, you can just type anything in the chat and let me know. As I'm waiting up, specialty plans, again, these are ones perfect. Josh, I will go over the employer plans then. So HSAs and ESAs. HSAs you obviously have to qualify for. You have to have an insurance plan that is HSA eligible, high deductible health plan. And then ESA, this is something like a 529. A lot of people aren't familiar with these. They're also referred to as Coverdell accounts, but you can use an ESA to invest in alternative assets as well. And you can grow that and use it for qualified expenses for today's expenses, okay? So let's go into it. So first and foremost, we have our traditional IRA. Now, as you can see on this slide, it's gonna be really hard for me to talk about all the pros for a traditional IRA. You can see a lot of them are here, but let me do a few, okay? First and foremost, the money that goes in is tax-free, right? When you put money into a traditional IRA, it's a little bit stronger because no taxes were taken out of it. And when you grow it inside the IRA, it grows tax-free. Now, when you're 59 and a half, you can take it out penalty-free, but you do have to pay taxes on it. So the argument that a lot of people make is if you put $5,000 in a traditional IRA and you grow it to $500,000, who wins there, you or the IRS? But you can make the argument that the IRS wins there, right? I try and stick up for traditional IRAs, and I say, well, that $5,000 might have only been $4,500 in the Roth IRA. So technically you got a free $500 investment. I don't know. It's hard to stick up for the traditional IRAs, okay? The second thing, and this is the most important, is a traditional IRA is where your old 401k money is typically going to land. Most of us are contributing traditional funds to our IRA because that's what our employer has always told us. There are a few geniuses out there, and I have them on my webinars every now and then that go, Daniel, I've been doing Roth contributions in my 401k. And I just give them a clap. And I'm like, you know, you're one of the few people, you can roll that into a Roth IRA. But most of us, we're doing traditional contributions. And one more, a little bit of a tangent. I just want to say, traditional just means pre-tax dollars, and Roth means post-tax dollars, okay? So if you don't know what you have, if you know you were contributing pre-tax dollars, that's how you know you have a traditional. And if you don't know what you have, but you know you've been contributing post-tax dollars, that means you have a Roth. So that was my tangent. So the traditional IRA, that's where your 401ks are typically going to roll over into, and then you'll be able to start doing the alternative investing. Now for the Roth. This one's the best. Let's be real. You put $5,000 in, you grow it to $500,000. You're not paying any taxes on that $495,000 that you grew. The one thing you have to do, I don't know the age of our group here, but if you set up a Roth, a brand new Roth, let's say at 59 and a half, or maybe you have a traditional that you convert over to a Roth, so you set up a brand new one by converting, you do have to wait 5 years before you can take out any of the profits. So small, kind of not a pro, I guess I would say, but it's not 5 years. You should be investing that for 5 years and growing it anyway. So it's not a huge deal I've seen so far. Also with Roths, it does operate the same way as a traditional IRA, right? Everything that's happening inside of it is all tax-free. So you put the $5,000 in, yes, it was taxable income, but it grows tax-free in there. And when you're 59 and a half and it's been 5 years, you can take all of that money that you grew out of it tax-free. And I'm going to show you guys a couple of examples on how that looks. So really fast, actually, I forgot. Any questions on these? Most people understand these, which are pretty self-explanatory. Also, $7,000 contributions annually, $8,000 if you're above 50. Give it a second if there's any questions. All right, now let's talk about the self-employed plans. So anybody in here that is self-employed qualifies for these two accounts. Now there's one caveat. If you want a solo 401k, you have to have 0 employees, okay? Now some people go, well, my wife works. That's fine. Wife being there is fine. Business partners are also fine. Josh, if I'm your business partner and we're running a business together, we could each have our own solo 401k plan, or we can have accounts underneath the solo 401k plan. So don't worry about that part. Now, I have a hard time sticking up for SEP IRAs on this one at all because SEP IRAs, really the only reason why you need one is if you have an employee and you want to do more contributions than the 7,000 to 8,000. First and foremost, all SEP IRAs are considered traditional. So for everybody that's paying attention, that means pre-tax dollars, and it comes out taxable, okay? Now, in order to do the $69,000 contribution, these operate differently. If you're in a SEP, you can only contribute 25% of your adjusted gross income. So to put that into perspective, if you make $100,000 in your business, you can only contribute $25,000, okay? Now let's talk about the solo 401k and how you can contribute here. As an employee, you can contribute, and I actually need to change this, very sorry, $23,500. And as an employer, you can match your employee's contribution, you can contribute your employee's contribution up to 25% of what they make. So let's talk about it. If you make $100,000 $100,000, you can contribute $23,500 of that. And as the employer, you probably want to max out your employee's contribution because you really love that employee, probably one of the best employees you ever had in your entire life. So you want to do the full 25%. Great. Now you can do another $25,000. Now, if I do math right, that's $48,500 that you can contribute off of just $100,000
Good stuff.
earned income. So a lot more you can get in here. I haven't even talked about that you can do different accounts under the solo 401k plan. You can do a traditional account and you can do a Roth account. So you could put all of your contributions into the Roth bucket. And now you have $48,500 inside of a Roth in your first year of just making $100,000 with your business. So it's really hard for me to stick up for the SEP IRAs. This one's a difficult sell. The only reason why these are great is if you have employees. Typically, where I see this is people who are self-employed and maybe they're employing their like family members because after a certain while, you actually have to start contributing, to the employee's SEP plan as well. And then whatever you're giving yourself, you have to give to the employee. Some things you have to start considering and looking at. So, any questions so far on this, especially since I have some self-employed people? I'm actually gonna wait a little bit just to see if anybody's typing. And by the way, as I'm talking, write these in because this one's complicated, and I just want to.
Yeah, feel free to take a screenshot.
Yeah.
So that you've got the details down, and we can always follow up later with more questions that you have. But I'd love to answer them while we're live here if you've got them. So bring them on.
And sorry if you see me reach down, my dog's kind of having a little bit of an issue with the thunder, so I'm trying to pet him every now and then. Sorry. Hopefully you understand.
Absolutely.
Last and definitely not least, this is how you pay for things today. Okay. Health savings account, covered out. I'm going to give I'm going to give stories on both of these. So a health savings account is really great because it actually acts as a traditional account when you put your money in, so pre-tax dollars, and it acts as a Roth account when you take money out, so no taxes on the way out. So health savings account's really cool. I actually have a lot of clients who use it for the tax advantages. So they put money in, they grow it, and then when they have a qualified expense, they can take it out for that qualified expense. Now, what are qualified expenses? Don't hold me to any of these, but I've seen them used, okay? If you ever want to know, ask your CPA or refer to the IRS website. But I've seen people use their HSAs for homeopathic drugs, so not like traditional Western medicine, prescriptions, glasses, right? Very basic. I've seen it for massages. And when I first came into the workforce, back when I was about 24, 25, one of my colleagues, who's also about my age, bought a juicer with his HSA. So they are pretty vague in what they consider health savings account qualified expenses, but just make sure you always check them. Now, let me give you a scenario here of how I see my clients use their health savings accounts. My clients aren't using their health savings accounts to pay for prescriptions and glasses and small expenses. They usually will have a second health savings account with like a Bank of America or something. So they have debit card access. They put a little bit of money in there and they swipe and pay for those things there. With the health savings account they have with us, they're using that to invest and they're growing it and they're saving their medical receipts, their qualified expenses receipts, and they're saving them up. They're saving up and they're saving them up. And then once they've accumulated enough, they take a big, hefty distribution, qualified distribution from their HSA savings account that they've been building with us. And then they do whatever they want with it. They're basically using it as an expense bucket. So as an example, we have a client that saved up a lot of medical expenses while growing his health savings account, took a distribution, a qualified distribution, gave their receipts to their CPA so they can match everything up, and then they went out and they bought themselves a Cadillac. Okay? So you can use your HSA as an expense bucket for your medical expenses that you're paying out of your back pocket. So you put, let's say, $4,300 into your HSA and you grow it to $50,000. You pretty much, this client bought a Cadillac for $4,300 because they just grew that money by investing. And it was tax-free going in and tax-free coming out as well. So that's one way of looking at your health savings account, which not a lot of people actually look at it that way because they're used to just doing debit cards. So covered else, so the ESAs, these are for kids. So these are used for expenses like iPads, internet, books, all sorts of stuff, okay? You can't put a lot of money in, but where I see a lot of people using their education savings accounts is very passively. So things like syndications, things like private money lending, things like wholesaling and assignment fees. I actually have a story of a client who uses their ESA, or used, the kids are older now, use their ESA to do wholesale. So they put an earnest money deposit in the name of the IRA, therefore the IRA owned it, and any proceeds that they made from it went back into the IRA, ESA in this case. And so what they did was they put a $2,000 earnest money deposit. They did an assignment fee to a fix and flipper, and they made $30,000. The reason why they did that is because their kids' private education was $30,000 a year. Well, in order to make $30,000 outside of an ESA, the guy had to make closer to like $50,000 because there's taxes that come out. With the ESA, he used $2,000, turned it into 30, paid for his kids' education tax-free. So it looks like a little bit amount, but if you do it yearly, right, you're going to get more. And if you're investing it, it also works. The other way you can invest both of these accounts is by marrying them onto deals. So you can actually use your IRA that has a lot of money and then throw in the ESA to cover a little bit extra. Oops, I'm sorry if you guys can see that. And you guys can use your ESA to cover that smidge extra. Yeah, it might only be 2% of the profits, but it's 2% more than it would have gotten just sitting off on the side by itself. And I'll talk more about how you can marry accounts. So any questions so far? Anything going on right here?
No, it's creative stuff. It's good stuff, man. Love it.
Awesome. So this is where I said I was going to kind of give an example of how the Roth IRA works. All right. We have a client. He actually turned his 401k into a traditional IRA and then converted it to a Roth, and then started buying up homes. He now has about 12 homes inside of his Roth IRA, and those homes all have renters in them. Those renters pay the Roth IRA. He makes about $12,000 a month from these renters, okay? And he's of the age, 59 and a half, and he's had it open for way more than 5 years at this point. So he actually distributes $12,000 every single month and lives off of that. Meanwhile, his rental properties keep going up. And let's not forget, rent is probably also going up too, but rental properties keep going up. So his value of his IRA is growing while he's living tax-free off $144,000 a year, right? So this is the power of a Roth IRA. Of course. We'll get into that in 1 second. Let me finish up this one. So this is the power of using a Roth IRA, okay? It comes out tax-free. Now let's talk about generational wealth building. When he passes away, this Roth IRA is going to be inherited. That person can live the same life for the next 10 years. There's a rule that you have to deplete the IRA within 10 years. But for the next 10 years, they can also live off $12,000 a month. tax-free. That's true wealth building right there. Okay. And then don't forget about the HSAs and the ESAs. They have no seasoning. They have no age requirements, just as long as they're qualified expenses. You can do the exact same thing. So let's talk about UBIT. I've had a hard time getting a clear explanation of this. It's because a tax strategist should truly be speaking to you about this, because they're the ones who should have the clear understanding. I definitely will be able to address it though, no problem. So first I want to talk here. So UDFI is unrelated debt financed income, okay? This is a form of UBIT. Inside of a solo 401k, you're actually exempt from that. So the reason why I came back to this is just because I'm going to touch on this. I'll do it in a second. I want to go over a few more things and then I'll get into UBIT. But I do want to mention, as we get into it, another powerful tool in a solo 401k is you're actually exempt from UDFI, which is unrelated debt financed income, which is a way that you can actually put your IRA on a non-recourse loan or be a part of a syndication that has taken out debt, and you can actually be entirely exempt from it. Don't ask me exactly how. Matt always just tells me it's a 401k rule that just so happens to spill over. And so it's just a really great, cool kind of, like, the IRS hasn't really tweaked it. So let's just take advantage of it. So let's get moving into IRA LLCs. I always like to talk about these just because it's like a bonus account. Okay, so everything I've been talking about in this example, sorry, I clicked too many. It's all done through your IRA. So Directed Trust Company helps you out in facilitating this. The extra step you can actually do is by setting up an IRA LLC. So as we all know, an LLC is just a pass-through entity. And the LLC will take on any benefits of the owner. In this case, it will be the IRA. All right. 1 second. I thought I closed out of that. Okay. Sorry about that. It will take on all the benefits of a self-directed IRA. Okay. So this self-directed IRA, now you are managing the IRA LLC, just like you were managing the self-directed IRA, but you're doing it through a bank account now, right? All LLCs have a bank account. So now you have what's referred to as checkbook control, okay? You can write your own checks on behalf of the LLC. So now when you go out and you buy that property, it's in the name of Josh Brannon's LLC. And when you pay expenses, it's in the name of Josh Brannon's LLC. And when you receive rent, the renters are writing out to Josh Brannon's LLC, okay? So that's how the IRA LLC works. If you're any sort of investor, this is great. If you're doing things like syndications or private money lending, sometimes just doing it out of your IRA is better. A lot of my private money lenders actually, we charge a fee in order to get the transaction out. And my private money lenders just charge the borrower. They're like, hey, it's a fee to get this money out. You're going to pay for it. And the borrower just gets, so our private money lenders don't even see anything. And then lastly, the multi-member. This is a way to marry multiple accounts. So as an example, the Mark J. Kohler, one of the owners of the company, he and his family all have IRAs, and they all own a piece of an IRA LLC. They're all different percentages, but that doesn't matter because all of the investments they do, that in that percentage they all own of it, it all stays the same, okay? Which is very important. Anytime you invest IRAs, the percentage always has to remain the same. So they actually have, I think they have 4 or 5 IRAs inside of an IRA LLC. And here's a little fun thing that they do is they go on little vacations and they call it a board meeting, and Mark writes it off on his taxes, and they decide what they're going to invest in for the year. And that's a CPA thing. You can go to Mark Kohler's page and find out about that. But they invest in things, and now his kids are growing their IRAs, his wife's IRA is in there, and his IRA is in there. And he also gets to educate his children on how to do good investing as well.
A lot of benefits to that.
Yep. All right, let's talk about, let me see something just really fast. I'm trying to think. You know what? Let's talk about disqualified transactions. and then I'll go into UBIT for you, just so I don't push your question off too far. So disqualified transactions are one of the most important things that you need to know in a self-directed IRA, because you are self-directing it, right? So the main parties that are disqualified: you, your spouse, your grandparents, your parents, your children, your grandchildren, and their spouses. 7 people. And I emphasize this is only 7 people, because I get so many people who call me up and they tell me they want to work with these people. And I say, please, it's just 7 people. You have your brothers, your sisters, your aunts, your uncles, your nieces, your nephews, your cousins, your father and mother-in-law, and you have friends, and you have enemies you can work with. You can work with 11 other people. Why does everybody always want to work with these people? Okay? Stay away from these people. There's nothing against them. Okay? In fact, some people would say you want to stay away from these people, but you can work with them. That's totally fine. Just stay away from these people when transacting. And I say transacting and I emphasize transacting because if you invest alongside these people, so at the very beginning of a deal, let's say you want to go into a syndication together. If you both invest at the same time, you're free and clear. You can invest together in the same thing. Let's say you want to buy a house together. You can invest your IRAs together at the same time. Now, let's say you invest in a home and you see, I need a little bit of extra money. I messed up on my ARV, right? Hey, significant other, can you invest in this with me? No, they cannot. They are now transacting with the deal. They're coming in after the investment has already been made. So you cannot transact with disqualified parties. So hopefully that makes sense. If it doesn't, write something in there and I'll go over deeper. But just know that if you want to invest with them, you do that at the beginning of the deal. At the beginning of the deal. So hopefully that makes sense. Ooh, also, I forgot because I don't have it on this slide deck. I'm sorry. Another thing you need to know about prohibited transactions is interacting with your own investment. That applies to transacting with your IRA. If you own a home inside of your IRA, you better not put a piece of duct tape on that leaky faucet, okay? That is considered a prohibited transaction, okay? You need to call up a plumber, have them go and fix it. Electrical problems, you need to call up an electrician, have them fix it, and you pay it through your IRA or your IRA LLC, as I talked about earlier. So you cannot interact or transact with your prohibited or with your investments. Another thing that I get when I bring this up is people go, but Daniel, I'm making my investment better. So what I always ask them is, would you do that same free labor on somebody else's property? And they always go, no, that's a stupid idea. Why would I do that? That's what you're giving your IRA. You're transacting with free labor, therefore it becomes prohibited. So that's the big reason, okay? So just don't interact with any of your investments. That also goes for unrelated business income tax. We'll just go into that right now. So unrelated business income tax is a tax that your IRA can actually have when you invest in things like a business. So if you own a business in your IRA, you cannot, first of all, interact with the business, right? Because that's you transacting with the business. And you also are subject to things like unrelated business income taxes, which are a different tax bracket, okay? And that tax bracket goes from like 0 to 2,000, I'll show you in a second, 2,000 to like 5,000, 5,000 to 10,000, and then 10,000 to 15,000. And that 15,000 is 37th percentile, right? So you're getting taxed very heavily at that point. That's the business side. That's owning and operating a business out of it. UBIT is an umbrella, UDFI falls underneath it. The way that I explain UBIT for a business, and hopefully this helps give you a clear explanation of the business portion. If a church runs a cookie shop, they're just doing a bake sale where they're making money and they're actually collecting profit. They're not doing it as charity. We all understand that churches are tax exempt entities, okay? If they are selling cookies and they're doing it as a profit, that's not fair to the cookie shop down the road, okay? So they are taxed at a different way, okay? The UBIT way. And again, I'll show you this bracket in a second. in order to make it fair, because they're using tax exempt dollars to try and make money. So it's taxed differently. Okay, so that's why it is done that way, because it's tax exempt and you're trying to do something other than an investment, or in a church's case, religion, right? So that's how it kind of works. Now, UDFI is the unrelated debt financed income. This can come into play in syndications that are taking out debt on the side. Hopefully, your syndication is using things like depreciation to keep the taxes down, because remember, you're just paying taxes on the borrowed money, not the money that's inside of your IRA. You're just paying taxes on someone else's money. Okay. And you can use things like depreciation to offset those taxes. You'll also be using things like, oh my God, why am I? Long-term gains. I don't know. Long-term capital gains. I don't know why I can't think of the exact word right now. So you'll be using things like that to offset those taxes. The other beautiful thing is you're only paying taxes on the debt owed. So if you're paying off the debt, you're also lowering that tax that you'll be paying at the end of it anyway. So you only pay taxes again on that debt accrued once you make all your money back from it. So once the syndication recoups all of its money. So does that make sense, Josh? And Scott, maybe I know we were talking about it earlier. Is that good?
Well, I'll add in a couple questions for clarification, and maybe Josh will throw in some more questions here, and maybe some of the other attendees want to offer something as well. But when you talk about paying off the debt, are you saying that it's possible for a syndication or your IRA to have borrowed money, paid it off completely, and then sold the property, and you don't have capital gains in a situation like that because you've paid it off completely?
But remember, I'm trying to stay away
Stay in
from
your
any
lane, right?
guarantee. Yeah.
Yeah. Okay.
So I talked about this example with Scott offline. So this is somebody who acquired land using debt, this was also using their IRA. Let's not talk about the syndication. Let's talk about land.
Daniel, can you hit the share button on that just to make it a little bit bigger?
Oh, yeah. No, it's present. Yep.
Yeah, present. You're right.
Yep. Let me get this out of here. It's not even like it helps on these slides anyway. So enter full screen. There you go. Sorry about that.
No,
and
that's
I'll
helpful.
just be
Thank
clicking back and forth. So this person actually used what's called a non-recourse loan. So this is like using debt leveraging outside of like a syndication where they're using debt leveraging. This is using a non-recourse loan. Typically, you're going to need about 30 to 40% down. They had to do 40%. So 119 of the 299. Now,
so the total invested, just to be clear, the total invested in this project is 120,000 out of the 300. So the only money that the IRA, the investor, has invested is the 120.
Yes. And so in this scenario, this person did this because they didn't want to use all of their 401k that they'd had in the stock market. So they only took out enough to just cover this deposit, right?
Yeah, and it includes and the lender fees and closing costs. Those are going to be included in that as well. So just to be clear.
And so you can see the interest payments were 25 months. So they were paying interest, right, on the loan. And then they sold it for 425. So the total UBIT paid is going to be the percentage on, I believe, whatever is left over of that loan. That's how I understand it. And that's why it's the net profit after the UBIT. So again, we're talking tax stuff. I hate to get too deep into it, but that's how I understand it. It's what's left over. And I believe it's the average over a 12-month period too. So if you are paying, if you're paying the total UBIT, so you cash it all out, it's whatever it was from January to December, I believe. I think it's that full calendar year. Trying to get everything straight in my brain. And so that's it's the average of that, and that's what you would be paying the taxes on at that point. Again.
Okay, so total profit before UBIT 92,800. The taxes paid 11,137. So the total net profit after all of The expenses are covered, 81,000. But notice that the return, the cash on cash return on investment is at 68%
Whoops.
based on that 119 and closing costs and interest payments. Okay.
Yeah. So this is big because remember, this guy had a larger IRA, but he wanted to keep some in the stock market. So he did it this way so that he could still make money while also using somebody else's money. So he made 81,000, we'll call it $82,000 while using 60% of somebody else's money. Okay? If he would have done it this way, right?
Just
He
paid
would have made,
cash.
yep, paid all of it out of his IRA. He would have made 120,000, we'll call it 121,000, but he would have only done 40%, and he would have had to use his entire IRA for that. So he was in the stock market. Not a great place, as I'm saying, as I'm trying to talk to you guys about alternative investments. Let's say he did 7 to 8%. So he made 7 to 8% doing that while using somebody else's money. So now we're looking at, somewhere around 75%. Right? So he's made more money using his money somewhere else as well. Let's say, by the way, he had opportunity to buy other pieces of land around this. If he would have bought just one other piece of land, now we're talking 162,000, all by using somebody else's money. So it's a very powerful tool. The owner of my company, Matt, who's also a CPA lawyer, that's why he loves talking about this stuff, because he can. And he can go into great detail on it. He says all the time, especially if you're in a solo 401k where you're actually exempt from this, you should be borrowing as much as you can. You should be playing with other people's money. Again, not my advice. I'm just repeating what my owner of my company says, who's a CPA lawyer. He loves it. He does it all the time too. So
yeah, this is great. I think that when I was at the seminar with you guys, I think this was the slide and the section that really stood out to me when Matt explained, okay, you're not paying taxes on your entire investment. You're only paying taxes on the money that you borrowed, which wasn't your money anyway. So the return that you get on your investment, you don't pay taxes on that. But the money that you borrowed, because it's not in the IRA, it's outside of the IRA, therefore it's taxable, then that's the part you pay tax on. But still, you wouldn't have had that money to invest unless you borrowed it anyway. So you have a way to extend your return and reduce your taxes significantly because you're using money that's for the down payment anyway, that is either before tax or after tax, or however it's done, depending on your type of IRA. But that's a significant benefit. And then if you add in that solo 401k, you just grew that thing exponentially because you wipe all of those taxes out.
Yep.
It's a really great option.
Yeah, and just to reiterate, he could have done 2 of these, which then puts you above what was over here. He couldn't do 2 of these if he cashed them out. Right. So he
Plus
would
the
need
other
600,000.
Yeah, and the other factor that you have in that scenario is you're diversified. You're across multiple investments as opposed to putting all your eggs in the one basket of that one house where you paid cash. So there is some benefit there that's pretty significant.
And just because I understand that for some people who are using their IRAs, I understand that this stuff can be kind of scary. This gentleman, this was his first investment. I would technically say he did jump off into the deep end because I think doing debt leveraging is a little bit more advanced. But he did this because he said, I don't want to use all my retirement. I'm a little intimidated because it's new to me. It's fresh. So he did do it this way because of that. So it's another way to say, you know what? I don't want to go all in. I'd like to figure out how this works and do it this way while still feeling safe because this is what I've been told is the correct move and everything that I always say we've kind of been brainwashed into thinking, which is stock funds and mutual funds only. Those can never go away. So it's also really nice to kind of comforting. I always tell people too, I don't know how many people are real estate investors and who are looking to find money, but if you've done this once or twice, it's really nice to empathize with somebody who wants to invest with you but doesn't have the money. And you can say, well, look, you can use your retirement account. I've done it. This is how I did it. And if you have any detailed questions, reach out to Daniel. He'll walk you through it as well. And then you can start involving yourself into making all this money that you see me making. And it's really nice to empathize with somebody when you're talking about their nest egg, right? So
Yeah.
it's a really good way of kind of easing people in by understanding how this works. And again, if it gets detailed, you just send them over my way, and I can talk them through it.
Sure. And related to that, again, gang, let me just say, please ask your questions. We're here for you.
Yeah, Josh.
We're not
Hopefully
trying to
that
monologue
answered.
or
Yeah.
just run a presentation here. We want to answer the questions that you have and make sure that you walk away equipped with the answers that you need. So in that structure too, one of the cool options that you have is working together with somebody else who has a self-directed IRA. So you could do somewhat of a joint venture, bring two IRAs into the same project and work together on something. He mentioned syndications. It's another way to move forward with investing through your IRA. But there's a ton of other things that you can invest in as well with an IRA, self-directed IRA. Do you want to hit the highlights of what some of the options are while we're waiting on questions coming in from our attendees?
Options to invest.
Yeah, like what kind of things can you invest in? What are the broad strokes of things that you can step into?
Yeah, so that would be this slide. So this is a lot, and I can even go further. I mean, we have clients that invest. They actually they run a business out of their IRA, so they do goods or services of production equipment, and they lease it out to like Netflix documentaries and shows and things like that.
Wow.
We have people who I think Mark tells a story of a guy who like bought a yacht with his IRA and then does like boat tours or boat like loans it out to people to take it out on like the Florida Bay or something. There's
Wow.
all sorts of stuff you can do in these things. But
Excellent.
I
Excellent.
I would say that the biggest ones currently, and to be fair, when I talk about real estate, about 6 to 7% of our clients are active real estate investors. That's like fix and flippers, people who are going out and actively looking for like buy and holds, things like that. Passive, I put under the promissory note, so private money lending, um, investing in like energy and natural resources. Um, those are more of like our passive people. Syndications is pretty big too. But cryptocurrency has been going gangbusters. Gold and silver has been going gangbusters just because of what I think, because of what it's been doing. But I would say the biggest things on the rise are these right now. And then just our biggest things as a portfolio are probably the real estate and the natural resources. So, and private
Excellent.
money lending, of course. I can, as an example, my cousin's husband, his dad, um, he retired and then he just used his IRA to start private money lending. Like that's all he does now. He just deals with real estate investors and lends out his money. That's all he does.
Excellent. Excellent.
Um,
Okay, we got a good question
yeah,
here.
yeah.
Let's go
Well,
over the fees and
yeah.
what's involved with the administration of a self-directed IRA and how simple is it to get started?
So 3 steps to opening up an IRA. One, you're going to find a custodian, right? Hopefully, somebody that looks like me. And you're going to want to book some time with them and make sure that, let's say you don't go with us, and you want to make sure that you're booking time with this custodian to talk things out. You want to know they should be asking you questions that are like, what are you investing in? What do you currently have? What are you planning on doing? You need to figure these out. You need to hash them out because that's what's going to tell them how to set it up, and then it's going to talk about your fees and everything. The next is funding, which is very simple. One, contribute, right? That's out of your back pocket. That's just money coming right out of your back pocket. That's the 7 to 8,000, 69,000 if you're an employer plan. Transfer, that's I always say like to like. So traditionals, Roths, those are going to just transfer over. Rollovers, that's when you have an old 401k, and depending on what funds you put in, traditional or Roth funds, is going to depend on what account it rolls over into. Traditional obviously goes to traditional, Roth goes to Roth. And then lastly, and make sure you do this in this order, is to find your investment. The thing that I hate having to do the most is when my clients call me up and say, Daniel, I finally found a deal. I'm ready to set up the account. And I say, great. What's the deal? And they say, it's a real estate deal. I say, great. When's it closing? And they go, 7 days. And I say, too bad, because it's going to take it. We move about 24 to 48 hours. Sometimes we can get the account set up in one day. Transfer, which is the fastest way to get your money over, 5 to 7 days. And sometimes it could be shorter, sometimes it could be longer. And it's not us. That's just banks talking to banks.
Yep,
And
yep.
last, if you're rolling over, that's 2 to 3 weeks. That can take forever. So make sure you have this thing set up and then go and find your deals. Okay. And just so you guys are aware, we're going to be giving a discount. So our fees are basically $495 a year. That's a flat fee. We don't punish you for being a good investor. Some of our competition does percentages of your account, which is crazy to me. Go be a great investor so we can make more money. So we're $495. It's a flat fee. Okay. And then to do a transaction, that's investing. I kind of skipped over that part. So investing in a deal, it's either going to be $50 for things like syndications, private money lending, very basic deals, and $150 if you want to buy like a piece of real estate. Let's be real. We all know a lot of paperwork goes into buying a home. A lot of checks need to be cut to a lot of different parties. So it takes a little bit more manpower on our back end. So it costs a little bit more. But for anybody who signs up from Grace Capital, we're going to give you guys $100 off your first year. And all you got to do is just use the code GRACE100. And you can book a call with me by scanning this QR code, or you can just send me an email and say, hey, can you send me over paperwork to get everything set up? Or, when's a good time to speak?
Fantastic. Okay, if we don't have any more questions, I think we're going to kind of land the plane. Daniel, great job. Thank you very much
Yeah,
for
thank you.
your contribution here. This is significant. So many ways in which we can, take control of where we invest, find projects that are not only helpful for our bottom line, but also helpful for communities. Being able to invest in real estate is a lot different than investing in Google. When you are providing a home for somebody and keeping that home nice for the community, that makes a difference. And especially in a time when the housing market is so tight and it's hard to get a place, that's something that really makes a significant difference. And so we appreciate this as an option, and appreciate too being able to work with Directed IRA and have the discount offered to our investors. Again, folks, if you have any more questions regarding this, do let us know. And I would just encourage you, don't delay. Like Daniel said, if you see this as, hey, that's definitely something I want to start moving towards, don't delay to start getting things set up. Get your paperwork in, set up a call with Daniel, set up a call with me if you want to talk some more. We'd love to sit down with you and just be able to, walk through what's available to you and help get you started. So thanks again for coming, everybody. Thanks, Daniel. You
Thanks
guys
for
all have a
having me.
great
I
night.
really appreciate it.
Absolutely, man. Take care. Thanks again.
Have a good one.
Yeah.